Ladies and gentlemen, Tesla stock had a kick-ass day today relative to the rest of the markets. All of your other Mag 7 names were in the red. All of your indexes were in the red. Specifically, small caps got destroyed as 10-year Treasury yields moved pretty significantly higher, up about 7 basis points, back to about 4.4%, which is the highest level we have seen in the last couple of weeks. Now, here in this video, I will discuss why I'm a little bit concerned about next week and my expectations there. Now, I still think most likely, because we're looking at things on a probability, metric, most likely we're going to have a year-end rally. But the other side of that, which is like a 30% chance that we crash into year-end or have a correction, is making me a little bit maybe a little bit nervous, okay? So I'll share my thoughts with you, perspectives on that. It really comes down to the breadth of this rally is starting to rapidly deteriorate. And now that does not necessarily mean even during some kind of correction, Tesla would do poorly. I think, you never know, but normally Tesla does fall during correction. So even if you're all in on Tesla, I think this is important to hear. But yes, I still think a year-end rally is most likely. We have a lot of catalysts coming next week. We do have some company earnings as well. It just feels like earnings season never ends. And well, there is some pretty big companies next week. And we'll talk about all of this in depth throughout this video. And again, I still want to say that a year-end short squeeze for Tesla makes a lot of sense, okay? As I've said before, and I will now say again, hedge funds and institutions, broadly speaking, have done well for their clients this year, okay? If you've done well and you have taxable gains for your clients, that's not exactly great because people don't like to pay taxes. So what you can do is if you have a short position in, let's say, Tesla, you can go ahead and cover on that short position, realize that loss, offset that loss to your capital gains, that you're going to owe, and boom, you're out of your Tesla short position. You're not taking that loss, which looks like it'll grow in 2025 into a new year, and you reduced your taxable gain burden for your clients. It seems like a logical win-win for pretty much everyone involved, and that would send Tesla stock higher, and at this point, that still makes the most sense to me. Like, why would you not cover on your short position if you are one of the, short sellers that are down massively in your Tesla short position? Like, why would you carry that into 2025 when 2025 looks like it's going to be another great year for Tesla? And even so, there's quite a few different individuals, hedge fund managers, technical strategists, that are calling for Tesla to rally between $700 and $1,000 per share over the next couple of months. So yeah, there's a lot of room to rally for Tesla here, but I am growing a little nervous based on what we've seen specifically over the last even 2 days or so in markets. Now, as I shared to everyone in the trading community here today, if you guys want to come join that, get access to all of the trades that I make almost every single day, we're trading in there. I send out alerts. You can come chat with me. Link down below in the description of this video if you want to join that. But I shared this post that I seen on X that says the stock market achieved something it has not done since 2001. 9 straight days of more stocks dropping than going up. That is negative breath. All while the NASDAQ made a new all-time high yesterday. Food for thought. And I don't care which way you want to look at that, whether that means markets could catch up or catch down. It really doesn't matter to me. Just declining breath is typically not a good thing for markets. Now, heading into next week, you do have some earnings to contend with. On Wednesday, you have General Mills, pre-market, and Birkenstock. Wednesday and after hours, you have Micron and others. And then Thursday is going to be your bigger day. You have Accenture and Darden restaurants, as well as Paychex, Conagra, CarMax, and Cintas pre-market. And after hours, you have Nike and FedEx. FedEx is seen as really a bellwether company to the economy. FedEx last earnings report was not good, and what the CEO and CFO said was just not comforting. It was pretty alarming, right? Last quarter, they said, you've seen the Fed did 50 basis point rate cut. I mean, that shows just how weak the economy is. Like when FedEx's top, people, top, officers and executives are saying things like that, it doesn't lead me to be very confident about what FedEx is going to say this week. And I think that is a potential issue that markets could be facing. But the economic data for this upcoming week, well, there's a lot of it. Okay, we clearly know we have the Fed on Wednesday, December 18th. But even just to start off Monday, you're going to have your PMIs, your global composite PMIs for December, your manufacturing PMIs, and services PMIs. Any weakness here, I don't think is going to be taken well, right? Because our expectation is in 2025 that PE multiples can be at the highest they've been at in decades because the economy is going to be so strong, because we're going to have all this deregulation. All of these things are supposed to go right. If we start to get weakening data, that's a problem. Now, we've seen a high initial jobless claims number. We've seen some weaker data over the past couple of days that markets have kind of shrugged off. But this week, if we get bad data, it's going to be hard to ignore, okay, for this upcoming week. Tuesday, you have retail sales month over month, expecting a really good number there of positive 0.5% month over month. People spending money is about 70+% of the economy. So it's vitally important that people are still spending money. Okay. A miss in retail sales would be really bad news for markets. It would likely lower 10-year treasury yields, though, and that could be a positive, at least a little bit for markets. So we'll see. On Wednesday, you have building permits in the morning, and then you have the Fed at 2 p.m. You have the rate decision. Everyone's expecting the Fed is going to cut rates. Like I said in the last video, there's like a 99% chance the Fed's going to cut rates and only a 1% chance that the Fed pauses. So they're going to be cutting rates. That's not the surprise. The economic projections, though, the Fed's dot plot could get very interesting. There may not be much of a change here, or there could be a big change here. Okay, we're going to get GDP projections, unemployment projections, Fed funds rate projections, inflation projections, a bunch of different projections coming from the Fed, and the markets tend to react to this a lot. And really for a couple of days, the markets will be latching on to that. So I think that is a risk that we have for next week, given how strong the markets, relatively speaking, have been since the election. I know not all areas have benefited the same, right? The banks have went up a lot. Maybe consumer staples have not went up as much, right? So it's kind of been a bifurcated market, but generally speaking, things have been okay. We do have final numbers for GDP on Thursday. Existing home sales, some Philly Fed data, smaller data in here. The inflation rate out of Japan Thursday. And then on Friday, we have core PCE month over month, expecting 0.3%, so a pretty hot number there. Personal income month over month, expecting 0.4%, a deceleration from last month. And personal spending, again, alongside retail sales, very important data point, is expected to go up 0.5%, month over month. So we have pretty high expectations that the economic data is going to be good for next week. In the off chance that the data weakens, that would set us up for a pretty weak second half of December. Now, historically speaking, the second half of December tends to be very strong. From December 15th through December 31st, the S&P historically rallies about 1.5%. Like, could that happen again? Of course. But I think the risk is growing that we may not see that kind of year-end rally. And on a probabilities metric standpoint, there's probably a 70% chance, 65% chance that we rally into year-end, and a 35% chance that we don't. I would say those odds have went up a little bit in the past couple of days. I would say 2 days ago, it was looking like the odds of a year-end rally was like 80%. and a correction or some kind of drawdown into year end was like 20%. So it's went up a little bit in the past couple of days, mainly because of this. One, here you have the percent of stocks trading above their 50-day moving average. Today, it got destroyed a bit. You're down to 52.51%. 5% of stocks today fell below their 50-day moving average. That's not good, especially on a Friday. That signals quite a bit of risk-off activity. People are uncertain. They don't want to hold some positions over the weekend. A saying that you may have heard in the markets before is down Friday, down Monday. Okay? If Friday's down, Monday tends to be red more times than not. And yeah, it just doesn't look great today. Also, when you look at CNN's Fear and Greed Index, the headline number today is at 50, which is exactly in the middle, exactly neutral. Yesterday, you were at 48, but today the markets are worse off than yesterday, so I don't know exactly why that's happening. Market momentum is in greed, but look at this. Stock price strength has deteriorated, okay, in just the last couple of trading days specifically. This is the net new 52-week highs and lows on the New York Stock Exchange. You're at 4.11%, right? You're getting to some pretty, bad levels for the index to be this high. Stock price breadth, you can see the McKillen volume summonation index is hitting some of the lowest levels you have seen since August, when we had a bit of that flash crash, right? You're getting down to some of those same breadth levels. Again, for 9 days in a row, you've had more stocks declining than rising on our markets, but yet what has happened over the past 9 days? Markets really have not moved at all, right? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 days ago, you were sitting at roughly the same level that we're at today. Almost exactly the same level, okay? But you've actually seen stocks fall over the past 9, 10 days or so. I don't think that's great. It really just means, like, think about it like a pier, okay? A pier on the ocean, whatever it is, wherever it is, okay? It could be Jersey, it could be Florida. You got a pier, right? There's a bunch of, wood beams that are holding that thing up. And over the past 9, 10 days, we've been knocking some of them down, okay? That's fine if things stop and we can kind of rebuild those and gain some momentum again, great. But if you get a hurricane that's some bad data, aggressive Fed, right? It comes crashing down. You start knocking out some more of those. In simpler terms, what I'm trying to say is the markets have grown weaker in the past couple of days. We have not seen this divergence between breadth and price since 2001. Now, this only does so good because it's not a 100% indication of weakness coming. And even if we do get some weakness, like, are we going to crash into year end? Probably not. Like, I still think some kind of 10% drawdown in December is pretty unlikely. I don't see a catalyst for that at this point. Again, unless the data is really weak and there's a growth scare next week, which, how likely is that? Probably not that likely. Could the Fed be more aggressive, more hawkish than we think? Yes. Could that cause some kind of downturn for markets? Yes. How confident am I that the Fed wants to, change their stance aggressively next week? I'm not that confident in that. That's why I think while the odds are low of a, rough second half December, they have risen a little bit recently. The structural foundation of our markets has weakened. Now, that could all change next week. Things could go back to being super bullish. That's certainly a possibility. Okay, I think just getting the Fed out of the way, whether they are a little bit more, hawkish than we expect or whatnot, it's bullish, right? Because we're eliminating a risk catalyst. And after next week, we get retail sales, we get personal spending, we get PCE, we get your flash PMIs, we get finalized Q3 GDP data. Like, there's a lot of risk catalyst that will be gone after last week or next week. Okay, so from that standpoint in and of itself, I think that's positive. Okay, because markets want to go higher. People are bullish. So knock those catalysts out, we could definitely move higher following next week. And that's why I think it's a 65-70% chance of a pretty nice year-end rally here. That's why I really do want to differentiate between Tesla and the rest of the markets. Tesla looks really good. The rest of the markets, not as much. Even if we did get some kind of weakness for markets, like you seen, yesterday, Tesla closed the day down 1.5%. That was a lot better than some other stocks, right? Tesla did relatively well compared to some of your, big tech peers that were down more yesterday. Okay, so I think Tesla's kind of in its own category, if you will, where there's so many things going right for Tesla. Why would you not cover on your short position? You're down. You got taxable gains for your clients. Cover on that short position. That makes a lot of sense. I don't think this gamma squeeze is going to end between now and year end. Although I do think you're probably going to get a correction in Q1, and that will slow things down a bit for Tesla. Okay, we haven't had a gap up with Tesla stock since November 6th. But yet Tesla's went from, following this gap up, $286 per share to $430 per share. I think we're overdue for a gap up, which could be anywhere from 7 to 10% higher for Tesla. I think there's a lot of positive things going for Tesla, and I would not want to fade the rally that Tesla is in right now. But the markets themselves could grow weaker. You could see something fascinating happen, though, for Tesla. Because what happens when markets are weak sometimes? Sometimes, not every time, but sometimes investors crowd into strength. Sometimes investors crowd into what is doing well on bad days. Some of that has to do with think about Cathie Wood for an example. If the markets are really red, she can't short stocks in her fund. Okay, so if the markets are really red and Tesla's doing well, Cathie Wood can go out and buy the winners in markets, right? And I'm pointing out Cathie Wood because everyone knows the ARK funds. They are not allowed to short stocks in those funds, okay? They can buy stocks though, right? So that's part of the reason why sometimes a weak market can lead to certain stocks doing very well and kind of inversing the markets. I wouldn't be shocked if that could happen over the next couple of weeks. If we do get that, 20, 25 percent chance of a downturn into the end of December. So I think, things just look way too good for Tesla to start growing bearish on the stock. I think we're likely going to be over $500 per share by the end of this month. But there are signs of deterioration under the surface in our markets. And that's really what I wanted to point out, as well as the potential risk catalyst we have for next week. There's a lot of them. I think they have to be pretty bad for the markets to grow concerned with them. A really bad retail sales number, I think would affect our markets negatively. A super aggressive Fed, a Fed that's talking about potentially raising rates, yeah, that's going to be bad. That's going to cause markets to fall, of course. But kind of in line data, in line bearishness from Jerome Powell, it's probably going to be a positive catalyst for markets. And even after the markets have weakened in the last couple of days, still think there's a 70+% chance of a year-end rally, but we will get a Q1 2025 correction. A lot of people are too optimistic. That's why, right? A lot of people have lofty expectations for next year. That's why. A lot of people think Trump's going to do all of these great things on day one. In reality, it's going to take some time for deregulation. It's going to take some time to know about tariff policies, right? These things are not going to just start on January 20th. And I think that's where some people are going to have to say, okay, maybe we're too excited for 2025 and start depositioning a little bit. So, and I also think we're going to get weakening economic data after the holiday season. January, February, March data is probably not going to look good at all. and you're probably going to get some more growth concerns. Mix that with decades high, price to earnings multiples, forward PEs for markets, and you're setting yourself up for disappointment in Q1, maybe even Q2. But next year, I'm pretty optimistic Tesla's going to have a very, very good year. And I even think the markets are going to have a good year. But there's definitely going to be some volatility in the early part of 2025. So let me know what you guys think about this information. I'm just trying to be as honest with you as possible, share what I'm currently seeing, what I'm currently thinking. I think Tesla's a bright spot, has been a bright spot, I should say, in a relatively weakened market in the last week or so that I think is very positive if you own Tesla. Not as positive if you want to buy Tesla cheaper, because it doesn't look like Tesla wants to go cheaper anytime soon. But hopefully that happens, because I would love to buy more Tesla at cheaper prices. So that is it, guys. Little bit to think about over this weekend. Nonetheless, let me know your thoughts down below in the comment section. Have a great rest of your day, and I will see you in the next one.